Hello and welcome to Chapter 25 in Principles of Accounting 2. Chapter 25 is going to talk about systems of performance evaluation. So this is where we talk about how we motivate employees, customers, suppliers to help our organization achieve our goals and objectives. So one of the ways that we motivate employees is by providing them incentives such as bonuses, etc. So we've talked about some of the different ways that this happens through different chapters. For example, in the budgeting chapter, we talked about how we can create and set goals through our budgets. Then, in the chapter that we just had, we looked at variances against our budget, and one of the reasons that we look at our actual budgeted results is that we want to determine if we were progressing towards our goals or not, if we achieved our goals, and then provide feedback about that process. If we do achieve our goals, then we want to reward our employees for that achievement. So when we're looking at the role of the accounting system in goal achievement, I'm just going to expand this window a little bit. So we already talked about, one, we create and set goals by making a budget. Then we compare that budget with actual results. We use that information to determine if our employees hit their goals, and we give them rewards. We have multiple different ways to measure performance and to look at performance measurement systems. One of these systems is called the DuPont system. This is a performance measurement that was created by the DuPont Powder Company. So these managers looked at performance evaluation system, and this performance evaluation system is still used today. How we use the DuPont method is looking at the return on investment. So the return on investment is a financial statement ratio analysis that we've already looked at in previous chapters, where we look at the operating income to the average investment used to generate that income. So we use ROI to evaluate performance. That's called the DuPont system. We have this example of the Saxville Corporation. They're trying to evaluate these two divisions, Division 1 and Division 2, by ROI. The corporation's expected return on investment for the divisions is above 14%. So we want to calculate the division's ROI. So as we said before, ROI is our earnings, our income, $720,000, for Division 1, divided by our investment. And I can see that I have a typo there because it's supposed to be 6 million. So 720,000 divided by 6 million is a 12% ROI. For Division 2, if we take 2.4 million and divide that by 15 million, we get an ROI of 16%. So when we're looking at this, Division 2 is exceeding our corporation's expected ROI for a division, but Division 1 is not. So then we would want to have more information about why Division 1 is not meeting that required 14%. So we're going to look at capital turnover and return on sales. So we can calculate the return on investment by multiplying our capital turnover times our return on sales. Return on sales is earnings divided by sales, or income divided by sales. And our capital turnover is our sales divided by our investment. So then if we look at those two divisions, if we had information about what their sales were in relation to their earnings and investment base, we could look at the capital turnover and return on sales to further analyze why they might not be meeting their 14% performance requirement. So that's this capital turnover. This tells us how well we're using our capital invested in assets to generate sales dollars. And return on sales tells us how much profitability we can expect from each dollar of sales. So when we're looking at this information, we have this breakdown between two companies, two divisions in our Bastille company from the textbook. We have fine china and cookware. So we have our sales, we have our average capital invested in assets, our operating earnings, and then we determine our ROI, our return on sales, and our capital turnover for each investment. When we're looking at the fine china division in year one, we show that the return on sales was 30%. This means that each sales dollar generates 30 cents of earnings. For the cookware division, we have each sales dollar generates 52.5 cents of earnings, or it's a 52.5% sales return on sales. So when we need to look at the impact on return on sales, we would need to reduce cost of goods sold or operating expenses without any impact on revenue, or increase revenue without a proportional impact on expenses in order to change that return on sales amount. So we have to reduce our fixed expenses, because remember, our variable expenses are going to change in relation to sales, or additionally improve our sales without increasing fixed expenses in order to change that return on sales percentage. So in year two, we show that we're able to increase revenue without a proportional increase in cost of goods sold. Even though our cost of goods sold did increase, the percentage of that increase was smaller than the percentage increase in revenue. So we had a 13.3% increase in revenue and a 12% increase in cost of goods sold. That gives us almost a penny additionally for each dollar of sales revenue. So we can see that we increased our earnings from year one to year two. Actually, sorry, we decreased. In the cookware division, we didn't do as well as the fine china division. So we had a cost of goods increase, an operating expenses increase, and a revenue decrease. So it's good to use the DuPont method and break down that return on investment into return on sales and looking at our capital performance so that we can see exactly where we're making changes in our return on investment and how we might be controlling that. If we're just increasing sales, or we're increasing sales and expenses, or we're managing expenses. Then we're going to look at our capital turnover ratio. So we have the China division has improved their capital turnover from year one to year two. They increased sales without a proportional increase in average invested capital. That means that they used their current capital expenditures to significantly improve sales revenue. Now, this could have been any number of things that's not disclosed to us in this information. For example, we might have purchased some piece of equipment that was more efficient at making china than we were currently using, which helped us to reduce costs but increase sales. There are many criticisms of return on investment. One of the reasons of return on investment is that if we're only measured and rewarded on our division's ROI, we might decide to increase profits and decrease capital investments in ways that are inconsistent with the best interest of the whole company. So this is where managers are doing things to make their performance look better that is not in the best interest of the company. So we're going to look at some of the criticisms of using ROI and the DuPont system as the only business performance measurement. So one is that it's a short horizon. This is because managers often move from one job to another. So ROI looks at short term instead of long term, because if those managers are just trying to improve their ROI now, they're not going to be interested about things that can change the long run horizon because they don't plan to be there for the long run. They plan to be transferred to another job or promoted somehow. So they might sell off a bunch of assets in order to make their average invested capital lower, which really bumps up their ROI. They might also reject good decisions. So one of those things that can happen is if we have a project that if we invest in, it's going to reduce our ROI because we're going to have to make a capital expenditure. So if I could potentially buy a new machine that's going to benefit the organization in the long run through cost savings and improved production. However, because I'm going to increase my capital investments, that's going to decrease my ROI. So I might purposely not take on a good project because I don't want it to affect my return on investment, because that's what I'm personally being measured by, my performance evaluation, and potentially my bonus. This is one of those reasons that we don't want to create bonus structures or performance evaluation structures for our managers that only look at one factor. Because if we make it based on one factor, managers will find a way to manipulate that factor for their benefit. The third thing is measurement problems. So ROI doesn't really measure exactly what's happening in the division. What if we share a capital building with other departments? Then that doesn't really affect the amount of investment in our division because we're sharing that with other parts in the company. We might not know how we want to divide up those capital investments if we have many different departments in the same building. Another thing that is against ROI is that capital investments are kept at historic cost, and it's all historic information. And sometimes historic information doesn't give you the best ideas about different things that could be happening within your company.